Hello, I'm Finola Burke from RaaS Research Group, and we're focusing today on Know Your People RegTech company, Kinatico, ASX ticker KYP. Joining me to discuss the company's recent H1 FY25 result is CEO Michael Ivanchenko. Welcome back, Michael.
Good to see you, Finola.
So Kinatico reported a 9% increase in H1 revenue, which includes a near 50% increase in SaaS revenues. How much of this growth is coming from conversion of existing customers to the SaaS platform versus new customers?
Finola, we've seen an ongoing increase in that percentage actually coming from new customers. And I'll actually say outstripping our expectations. I can share with you at this point that we're probably, for the last half year, 80% of that is new versus 20% was converted. So of a total about $4 million worth of SaaS that we've actually added in the H1 of the year, 3.5 to 3.6 million has come from contracts of new logos.
Right. And the impact for the company jumped 17% in H1 to 416,000 with good cost containment in operating costs. Can we expect to see this operating leverage expand as revenue continues to grow?
Absolutely. I mean, that is our objective. I've spoken about previously how we have this ongoing dual focus within the organisation of optimising the existing or the legacy business, taking cost out wherever possible, optimising through intelligence and automation, while at the same time our investment in our next generation platform and all the things that our customers want. So we see it as a bit of a widening gap that we're attempting to achieve, that we get this ongoing efficiency, increased effective gross margin, I'll call it, and I'll come back to why I call it effective gross margin, while at the same time we start to see the top line revenue growth, which we've seen in the first half of the year. I call it underlying gross margin because there's this accounting anomaly that we see in the short term that as we introduce automation, that actually can marginally affect our reported gross margin, but our income statement effect well and truly outstrips that, because as we remove operational costs, they're not actually counted against the gross margin, but the cost of some of those automation suppliers is. But we see it as a short-term thing.
And you have been investing in developing the Kinatico compliance platform, which I believe you'll be unveiling to the market shortly. Do you anticipate further significant investment in that platform? And have you any indications from clients as to take up? I mean, is this another game changer for Kinatico?
We certainly hope so. We think so. Very happy to announce that next Thursday will be the first time, the 6th of March, we'll be showing it at our investor webinar. The platform is designed to meet all of the objectives that we are hearing from our customers. In the trials and market testing we've done with our customers and them using it, the response has been overwhelmingly positive. And certainly when people see the platform, they immediately see the benefit of the savings in both time, overhead, but most importantly with trust and visibility across their status that was previously unavailable. So that delivering on that promise of genuine simplified compliance, along with the data protection that everyone expects in place, along with the immediacy and the ability to take current, whether it's manual or analog processes and procedures and documents that you have in organisations, and instantly being able to distribute them digitally and then track that acceptance, we really do think is a game changer.
And Michael, do you think do you need to invest further in the platform from a perspective?
Yes. Look, as a software company, we're always going to look to stay ahead of the market. But having said that, we've reached our high water mark. So getting this year and getting this platform out to market will represent the highest point of our investment. We're over the hump or reached takeoff speed of an aeroplane, and we expect that to materially reduce next year.
And you ended H1 with $9.9 million in cash, which was an increase on the cash that you held at the end of FY24. What opportunities do you see for deploying this cash in the year ahead? And then the flip side is, do you feel that Kinatico could be a target for takeover given its strong cash position and operational growth profile?
So we are always looking at the best way to increase the overall value of the organisation. And if that involves utilisation of some of our cash reserves, we will do that if it makes sense. So we're always on the lookout for something that can either increase our market share or accelerate our product portfolio. We have struggled to find anything that wasn't going to be a distraction from the trajectory we're on at the moment, and that is an important factor. So it is a nice position to be in when we are investing as much as we have been in our platform dev, but also managed to remain cash accretive through that period and increasing our NPAT through that period. So it's the strong balance sheet and the leverage, operating leverage we continue to build is great. But as you say, that does, I think, run the risk of us being taken out, quite frankly, too early. That's certainly the feeling of the management team and the board is one of our big risks while we're on the trajectory that we are demonstrating, is that we get it taken out too cheaply.
Well, thank you, Michael, for your time today. I'm looking forward to catching up with you over the course of 2025 and certainly on March 6th for the launch of the compliance platform to check on Kinatico's progress.
Thanks very much, Finola. Always good to talk.